We talk a lot about real estate on this program, but we haven't really gotten or done a deep dive in a long time. And by deep dive, I mean taking a look at housing trends and prices in our local market. So I've asked Ken Johnson, real estate economist at FAU, which is Florida Atlantic University, to join me today and to share some of his terrific research. Hey, Ken, welcome to the show.
Good morning. Glad to be here.
So you've recently written some articles or contributed to some articles where you've discussed that real estate prices and demand have reached certain levels, and you basically made a statement here that says, where have all the good deals gone? What are you saying there?
Well, when we look at prices in Palm Beach County, we're definitely above the long-term pricing trend. So at this point in time, all the good deals are gone. We're above that pricing trend. Many people, however, are still buying because they're trying to lock in a price before they fear it can get too high.
What is a good deal? I mean, how do you measure a good deal versus what? Affordability versus historic trends?
Well, so we're looking at historic pricing trends. So we have about 40 years of data, and it's an HPI, Housing Price Index. So it's pretty much like the Dow. So you're looking at percentage changes. And so with the 40 years worth of data, we simply run a linear trend through it. We'd run a line through it and say, where should you be? You should be on that line.
Like a smoothing out line.
That is correct.
Okay.
That is correct. And then we look at, well, where should you be, but where are we today, and just calculate the percentage difference.
And you, to restate it, we're above that trend.
That's correct.
To what degree?
Just under 20% in Palm Beach County.
Just about 20%. So is that an egregiously high amount? I mean, I'm thinking back to like '06, and we're going to touch on '06 a lot, or '08 rather, '06, '08, because, you know, real estate, obviously, we all have a little bit of a post-traumatic stress disorder there, worrying about is the next bubble coming. But, you know, what level did it get to back then?
So we're at 20% now, and while that number's a little shocking, if you look back to where we were at the peak of the last bubble, it was 66% above.
Okay, so we're nowhere near that.
We're nowhere near that.
All right. Now, a homeowner or someone who's looking for a domicile has a couple of choices. You don't have to own, you can rent. And you guys have come up with this index, which I find to be terrific and quite fascinating, taking a look at the difference or comparing the idea of renting versus buying. Take us through how that index works.
So in its simplest terms, what we try to do is think of two houses perfectly identical across the street from one another. One is rented at the market value, the other is sold at the market value. So you look in terms of wealth creation. The owner is going to have to assume the cost of ownership, mortgage payment, taxes, insurance, maintenance, etc. On the rental, you have the rental costs, but then you take any sort of rent differentials in terms of what you would put into the house plus the down payment, and that what you would not be necessarily putting into the property if you were renting, and you invest that difference in a portfolio of stocks and bonds, and you see which way on average produces greater wealth.
All right, so that is the question. So I have a gentleman in my office who's recently married. They're looking to have some kids in the near future, and they're looking for a house. And he's actually frustrated because he's not finding the kind of house in the price range that he wants. But I don't know that he's really considering renting in the sense, because he says, well, we need another bedroom and all of this. But today, what is the rent versus buy index telling us?
Right now in Southeast Florida, this number actually works for the Tri-County area because we have 3 counties worth of data that we build the calculus out of, if you will. So when we look at the number right now, it's at 0.28. That roughly sits in this 3-county area in Southeast Florida as about a 15% chance to own and create wealth as opposed to rent the same property and reinvest in that portfolio in stocks and bonds. So we're favoring renting right now instead of ownership. But there's a lot more that goes into ownership than just an investment.
But let's take a look at those numbers, because I do agree with you, and I want to get into this aspect of what it really means to own a home. So out of 100 people, 15 will benefit from home ownership. So 85 would be better off renting.
Renting and reinvesting.
Renting. Okay. Yeah, reinvesting. Yeah. So really, in the real world, I don't think people are reinvesting the difference. I think in the academic world, you've got to do something with that money. But I think what we're saying here basically is that if you're a disciplined saver and you're really thinking about creating wealth and your home is part of that equation for that person, then this metric is very valuable to you. If you can rent, take the difference, reinvest it in a diversified portfolio of stocks and bonds over time, right now where prices are in the buying market, you're probably mostly better off renting.
I would answer the question three ways. There's three things that drive should you be renting or owning that we can find in our research. And one hits on the key point that you've been talking about, the discipline to save. Home ownership is, at its basic setting, what it does is it forces you to save.
Right.
So this is a great thing. This is how Americans have been able to take advantage of a levered financial investment in which they happen to be living in for years and years and years and years. But it forces you to save. And so as it works out, it will be better if you are a disciplined saver, for example, on average to rent and reinvest. On the other hand, if you're not as disciplined of a saver, you would perhaps be better off to own and build equity.
Yeah.
Couple other points. If you tend to be upwardly mobile and you're thinking about moving, especially from one metro area to the other, renting and reinvesting, I should say, is like a call option. It's a lot less expensive.
And owning a home is an anchor.
That's correct.
And it's not as liquid. It's expensive to sell.
It's very difficult to sell.
Very difficult. So if you are upwardly mobile, I think that's an excellent point, this idea of being able to move when you need to move and not to have the baggage, so to speak.
That's correct.
Of owning a home. That's really very important. With regards to the amenities of renting, you see these ads for these places and they have, these great gyms and tennis courts and all of that, but it's not quite so simple as that. Tell us about the amenities for renting and the amenities for owning.
So when we looked into this, we came up with a shocking conclusion. If you really like amenities, on average, you're better off owning them.
That is shocking because you think all those fun people or those people having so much fun in the gym and all that.
Well, but it turns out, think about this. If you are the owner of property that you are renting and you have really nice set of amenities, what you tend to do is apply a premium because the tenants in your property will not take, on average, as good a care as owners do in the same property. So you simply apply a renter's premium.
I see.
Sometimes we refer to that as the kegger premium.
The kegger premium. Okay. I'm sorry. That's because a keg, you mean like a keg of beer?
That's correct.
I'm sorry. I'm too old to remember that all that well. Okay, the kegger premium. So even though you don't actually know it, they're pricing in their costs.
They are.
Of that depreciation and that extra maintenance in the rental price.
All the data shows that.
Okay, so if you own your own home, you have your own pool, and maybe you have a club membership somewhere, or a member of a tennis club or something like that, you're better off, generally speaking, than renting in this case.
That's correct.
Okay. By the way, my guest is Ken Johnson, real estate economist at Florida Atlantic University. We're talking about the real estate market, and we're trying to get down to the numbers here. And Ken, this is fascinating stuff. I love the way that you guys are measuring demand in the marketplace and therefore kind of somewhat a predictor of future prices. If demand is slackening, then future prices may go down. If demand is increasing, the reverse is also true. But it's also important to remember that a home is not just about investing. It's about consumption, and there's other benefits to owning a home. Let's list some of those real quick.
Sure. So it is a consumption. It's also a necessary good. We all have to have shelter, but it's consumption in terms of we enjoy it. Other things that come out of home ownership is research shows again and again, you get better societal outcomes in terms of higher voter participation, lower crime, higher educational outcomes. So there's lots of reasons to own that aren't necessarily financial in nature.
I know in my own experience, I've noticed that if you're bringing up children, it's better to have kind of a more stable community, which is represented more by home ownership, than it is a rental community where it's more transient. Maybe populated by a lot of upwardly mobile people who are looking to move out. But I think it's a little bit more difficult, perhaps, to build strong long-term relationships for your children and their parents.
Well, that's not our area of research. I couldn't disagree with that. I would think, anecdotally, that's exactly what I would expect to happen.
Okay. I want to get back to this question about rising prices and the fact that the markets are different today than they've been in the past. We're talking about real estate markets here. In the past, real estate used to be kind of a consistent, steady increase or slow decline, but that's changed. Tell us how that's changed.
Absolutely. We've seen a change. So have we had cycles in the past? Even in our data, we see cycles, but there was very little movement above or below that long-term smooth trend. The last 2 cycles, we've had dramatic swings above and below. So that brings in the question of the timing of when you purchase or when you sell.
Yeah, so let's talk about that. Now there is a metric that you've created, you and your partners have created, which gives us a basis to make that decision. So as prices are rising, but demand is starting to decrease, what does that tell a potential buyer?
If prices are rising, and in real estate, unlike equities, you do tend to get momentum. Okay, so you can get prices that will overshoot the mark in terms of housing prices. So if prices are rising and demand is starting to slacken, then you can expect sometimes in the near future to have a pricing event. So there's 3 things that could happen in a pricing event. Prices could go down, properties could extend their marketing times, and or the likelihood of a transaction during a given marketing effort could precipitously fall. Now, that's pretty critical to people that have to sell.
Okay, let me recap that a little bit. So prices could go down,
That's correct.
Right? Or it could take longer to sell your home,
That's
which
correct.
would create pressure for prices to go down, I would think, because people are going to start cutting their prices. And what was the third one?
The third one is the likelihood of a transaction during a given marketing period. In other words, I have to sell. I've already bought another home. I've lost my job. I've transferred to another city.
Got it. So in that term, we are in a rising pricing market today.
Present. That's correct.
Right? But your numbers show that demand is starting to taper off.
That is correct.
Okay. Not generally the best time to buy if price is the key.
That's correct.
Right. Again, there's all these other reasons to buy a home, but if we're just taking a look at the numbers, it's not the ideal time to buy right now.
That's correct.
Okay. Let's take the reverse.
Okay.
Let's take post '06, and assuming that you had capital and you weren't shut out of the market, you had good credit, you would see prices were falling, but demand was rising. And let's say that would be the perfect setup. I don't know if that actually happened. You take it.
So what happened right after the peak, there was still a limited demand. You saw prices falling, and the demand for home ownership was also falling. But what was happening simultaneously is that prices were getting to be good.
Yeah.
And at some point in time, roughly around 12, we saw a bottom in almost every market in the U.S. where we hit our price point to where you could say people were just saying, that price is too low. That price is too good.
I'm not selling.
Or I'm buying. No, I'm so
buying.
sorry. I'm
Yeah.
sorry. The prices were so good by 12, and our index score was definitely reflecting an increase in the demand for home ownership, and people started buying.
And that would have been the time to buy. So
That's correct.
It's in a sense, on an investment, all investments really kind of work the same. They have different characteristics.
That's
They
correct.
have different levels of liquidity and rates of return and things like that. But it's still a question of value for your money and the cost of money. And this is another thing I want to close with. A lot of this is driven by interest rates. So
Correct.
when mortgage rates were at 7%, I could only afford a house worth X. If interest rates dropped to 3.5%, theoretically, I could own a house 2X. It's not exactly, but
On the debt service, yes.
yeah. And we see this in corporate America all the time now. Companies are paying huge prices for other companies because their cost of debt is so low. So it's just kind of the law of gravity. It's the way money works. To what degree are interest rates? Now, interest rates have come down recently, and I don't know if it's necessarily filtered into the mortgage market, but any minute it's going to. Do you think there's a possibility for increased demand, and we'll leave it there?
Sure. On interest rates, this is really the big overhang that we have. I think, Steve, you and I are of an age where we could remember much higher interest rates.
Much higher.
And so this really hangs in the back of our mind. What happens if we do see 7, 8, 9, 10% interest rates again? Quite honestly, it would be a disaster for the housing market.
Oh, yeah.
However,
What about 5%?
even 5% relative to where we are right now, because all financial experiences are local and recent.
Mm-hmm.
We much more remember the near term than things in the far distant past. So right now, rising rates, it's the big threat in the housing market. However, we noticed that the rates went up and then they flattened back out. And if you look at the yield curve, I get so tickled if they're talking about the yield curves inventing. It's virtually flat right now, between the 1 and the 10-year.
Yeah, but the point is that your numbers, which show demand slackening, may be a result of the higher interest rates we were seeing 3 or 4 months ago.
Well, here's what would happen in our model, because we look at the cost of home ownership and then the reinvestment alternative for the renter. So the cost of home ownership would skyrocket, which would force down the demand, meaning the periodic cost would go up. If interest rates went up so much, that cost would be so tremendous that people would naturally start to demand less home ownership.
Yeah.
Because they could, on average, outperform renting and reinvesting.
This is the kind of stuff that we don't really talk about a lot on the show. I don't know that a lot of people are talking about the numbers in real estate the way you think about investing on businesses or in the stock market or the bond market. And I really appreciate you coming in. To hear this and any interview again, if you have a question about what we've just discussed or a comment, visit our website, stevepomeranz.com, to join the conversation. And while you're there, sign up for a weekly update for upcoming live events and the important topics we've covered this week straight into your inbox. That's stevepomeranz.com. Ken Johnson, real estate economist at Florida Atlantic University. Thanks for joining us.
Enjoyed it, Steve.
Joining us.
Enjoyed it, Steve.